In the first video we talked about what debt is. In the second one we discussed about two very important types of debt. And in the third one we talked about the periods of inflation and deflation in the short-term debt cycle. So let's see in this fourth video what happens when credit is too high and the decrease of the interest rates is not enough anymore as a solution to the period of deflation, period that we also call recession. Hey, it's Dario and this is Divity Finance, a platform where we can share our best tips and tools when it comes to trading, investing or finance in general. And if you love the subject, please consider subscribing. A recession is the period of deflation in the short-term debt cycle. This was the topic of the last video. To stop the recession, the central bank will decrease the interest rates, and this cycle will continue until it will reach a point where the credit, and so the inflation, will be too high. We will therefore enter a period of recession which is gonna last way longer, and it will be much more violent. This period is also called a depression. In the last video we understood that when there is inflation, the value of every dollar will decrease. Thus, the cost of every good will increase. But when inflation is too high and when there is a very high level of credit, we will arrive to a point where people will have too much debt. Therefore, they will have to start paying them off. To do it, people or companies will start cutting costs and selling their assets like houses, stocks, factories, companies, and so on. This, though, will happen with great hurry and nervousness, so much that the level of supply for these assets will increase drastically. And on the other side, we have less and less demand, because everyone needs to pay off the debts, and so fewer people want to buy. This will result in a decrease of the price of assets in general, because people will ask less and less money just to get rid of them. Still, in the last video, we understood that the expenditure of a person is the salary of another one. Therefore, if the price of goods goes down, the salary will go down as well. And with the salaries going down, the expenditure will go down, which will then bring down the salaries even more. And this will go on in a nervous and full of uncertainty environment. At this point, the central bank tries to lower the interest rates to try to give more credit that can pay the previous debt. But unfortunately, the levels of debt are so high that people are not worthy enough to receive any more credit. The period of deflation will then go on, and it's gonna shift very quickly to a depression. This happened, for example, in the US in 1929 and 2008. During this period, the central bank cannot do much alone, and so we need someone else that can help putting the economy back in equilibrium. This someone else is the government. Since in this period companies start to cut the expenses to try to repay debts, the unemployment rate will start to increase. And to help the unemployed, there is the government with incentive programs and unemployment benefits. But also, the government is short on money in this period. This is because people earning less will pay less taxes. So, we need the government and the central bank to work together. But how can they help each other? It's very easy. The central bank can print money. With that money, though, it must buy financial products. And these products, in this case, are exactly government bonds that are issued by the government. On a practical level, the government is gonna issue some government bonds. This will then be bought by the central bank. This way the government will have enough money to finance the incentive programs and to pay the unemployment benefits. And so liquidity will enter the economy again. Slowly but steadily the deflation rate will decrease and we will go back to a period of growth. People will be worthy of receiving credit again, they will start spending more, earning more, and so the wealth will increase. We can understand that the economy swings from period of great expansion to periods of depression. During the first period, wealth increases, the expenditure increases, and salaries increase, even though there are some periods of recession. During the second period, the expenditure is cut, assets are sold, and unfortunately, the decrease of the interest rates cannot lift up the economy. Thus, there is the need to ask for help to the government. This oscillation can be schematized with a cycle, and this is called the long-term debt cycle, and can last even more than 60 years. There is no need to be afraid of these cycles though, and more importantly, there is no need to be afraid of inflation. Indeed, we should first learn about it, understand why it exists, and why it is important for our economy. As we understood from this series of videos, inflation is necessary for the economic and wealth growth of a country. Because of this reason, central banks normally have an average target of annual inflation of 2%. Besides understanding the reasons of inflation, we understood that inflation leads to a decrease in value of our money. And so if the goal is to have an average inflation of 2%, it means that our money will lose 2% of the value every year on average. And so, how can we solve this problem? How can we make sure that our money will keep its value throughout the years to come? To achieve this, we need to put our money in the mechanism of economy. But to understand how to do it, we will meet in the next video, where we will see how to counteract the inflation and put our money in the circuits of the economy. So, if you haven't done it already, I would highly suggest that you subscribe immediately to the channel so that you can always be up to date whenever I post a new content. And I'll see you in the next video.